All right, my man Chuck had sent me this article, Why Your Portfolio Might Need More Stocks. And it's a lot of the things I've been saying for a few years about bonds. I want to read this. Come here, buddy. And then I want to go over the chart that they're talking about because there's a lot of important stuff here for sure. All right, so this is from Amy Arnott. I wonder if she's married to Rob Arnott from Research Affiliates. Anyway, bonds have been a beautiful thing over the past couple of decades, compounding returns at a decent clip while faithfully filling their traditional roles as buffers in down market. But now the interest rates are close to their all-time lows. Their future return prospects are much lower. Yeah. Let's see. We generally shy away from making predictions about long-term market returns, but for planning purposes, investors need to use some type of return assumptions. Let's see. Looking at long-term historical norms is a place to start. Over the 92 years since 1928, Treasury bonds have averaged 5.15, while medium quality corporate bonds have averaged 7.22%. Wow. If you subtract inflation, real returns are 2 for Treasuries and 4 for corporates. But it's highly unlikely that bond returns will reach that same level over the next 10 years. I couldn't agree more. And here's a chart about the Treasury bonds going back from 2002. It's a 10-year Treasury. It's over 5, and now it's below 1. Yield. Now, listen to this. What I've been saying for a long time. Yields make up much of the return bond investors get. So rock bottom yields suggest future returns are likely to be far lower than in the past and may not even keep up with inflation. Could not agree more. Lower future returns have profound implications for retirement planning. Investors who stick with the same asset allocation guidelines that work in the past will likely fall short of their goals. They talk about a couple of hypothetical investors here. One who starts with $300,000. I don't want to read all that. It's kind of boring. But anyway, you can see the potential savings gap on a. If you look at bonds with their with what they've been historically relative to what there could be, it's a pretty significant difference in terms of hundreds of thousands of dollars left on the table. I'm not going to read you those numbers because you can do it yourself. Stocks to the rescue. Oh, handsome. Of course, the safest way to improve a long-term portfolio's prospects is to boost or reduce withdrawals if you're retired. Boost contributions or reduce withdrawals. But a higher equity allocation mix could help fill some of the gap. If we shift to an 80-20 mix and stick with more conservative return assumptions, the ending balance gets closer to the original level. They're trying to get $1 million. But anyway, so let's keep going here. I want to share with this chart right here. Risk return trade-offs for different asset mixes. All right. So this is interesting because I did a couple, I didn't do a spreadsheet here, but I took some calculations. And I said, okay. So risk returns for different asset mixes. So 15 years, we got the bond index, we got the stock index, and everything in between. So I want to share with you something here. So total return for the last 15 years, as of the end of May 2020, on average was 4.39 for bonds, 8.7 for stocks. So basically twice, and this is the nominal return before inflation and certainly before taxes. Standard deviation was 3.28 for bonds and 17 for stocks. All right, so I want to dive in this a little bit. Now you get 4.39, 8.7, then it goes 6.9, 7.3, 7.7, 8.12, 8.43. That's the stocks. That's the returns, I should say, for 15 years. Standard deviation, 3.28, 8.5, 10, 12, 13.5, 15, and 17. So I want to share with you what a standard deviation means. All right, so that just simply means 66 roughly % of the time, in whatever time frame you could look at annually is what we're probably doing here. Standard deviation 3 years. Okay, cool, 3 years. So 66% of the time in 3 years, the market average would be 16.94% above average, and the average is 8.7, or 16.94% below average. That, all right, so if we look at it, we'll just say 17. So you take 17, you add 8.7. So 66% of the time, you got no higher than 25%. We got 17 plus 8, that's 25. And you take 17 minus 8, that'd be what, 9. So your return 66% of the time over the last 15 years were between -9 and positive, what I say, 25. But 3 standard deviations is really what we're shooting for, because 3 standard deviations is like 99.6% of the time or something like that. So in this case, you average 8.7, but your total max and minimum 99.6% of the time would be 59.5 on the positive and 42% on the negative. I hope that makes sense. So yeah, a huge range of a 3-year return. Minus 42% on the negative, plus 59.5% on the positive. You see how it's skewed, by the way, towards the positive, because the average is in the positive. So the average is in the positive, which means a standard deviation will skew more to the positive and less to the negative, simply because for a standard deviation, where the average is 8.7 and the standard deviation is 17, the first 8.7% is that still in positive terms. I hope that makes sense. I know it's confusing, but you got to think about it like this. All right, so what I did is I said, okay, how about bonds? Well, bonds, you had a standard deviation of 3.28 with an average return of 4.39. So within 99.6% of the time over the last 15 years, bonds averaged negative, you would have received negative 5.5% or positive 14.23. 99.6% of the time for stocks, you would have received negative 42% or positive 59.5. So a lot of people say, I don't want to lose 42%. So they say, I don't know. We're going to dive into this next. All right, so we look at an 80-20 mix. An 80-20 would have been negative 32 or positive 48. We'd taken 50-50. It would have been negative 18 or positive 32. All right, so the difference between the net, because no one cares about the positive, they care about the negative. So 50-50, you would have received 6.97 a year, and you would have had less than half of the risk, actually almost 2.5 times, the stock's about 2.5 times more risky. But you would have had negative 18 on the down, 32 on the up. But stocks would have had negative 42 on the down and roughly 60 on the up. So basically, it's basically double the risk and double the return. But you're not getting double the risk and double the positive, I should say. Double the risk and double the up. Double the negative, double the up. But you're not getting double the return. You're getting 6.97. That's what you received over the last 15 versus 8.7. So people say, why would I take twice the risk even if I'm not going to get twice the return? Well, let's take a look. So I did, okay, well, let's see what we got when we do $100,000 after 15 years. All right, so 15 years, $100,000 at 4.39% in bonds would have given you $190,000. You wouldn't have even doubled your money. $100,000 after 15 years at an average of 8.7 would have given you $350,000. $100,000 here, though, at 50-50 would have only given you $274,000. So by taking double of the risk in terms of standard deviation, you increase your portfolio by, let's say, about $80,000. And $80,000 over, oops, let me get this going here. I should have brought my calculator. Hold on a second. 80, we take our trusty calculator, we do 80 divided by 274. That is 29% more return because you're willing to take on, how much more risk? You're willing to take on, 42 minus 18. Oops, 42 minus 18. You're willing to take on 24% more risk, if that makes sense. I know that's confusing, but that's what I'm talking about. So you're saying, all right, I still, on the worst case scenario, I would have had $100,000, which could have lost down. I could have lost $18,000. $100,000 could have gone down by $18,000 with 3 standard deviations in a 50-50 mix. $100,000 here would have gone down to lost $42,000 with 3 standard deviations. Now that's not very likely, but that's 99.6% chance that would have happened over the last 15 years. We're not predicting the future. That's the thing with standard deviation. No one has any idea what the future is going to be. You got to remember that. This is just the past. The past is I don't want to say irrelevant, but the past you cannot hang your hat on to say this is what the future will hold. So we're saying, okay, at $100,000, within 3 standard deviations at a 42% on the negative. So my $100,000 is worth $58,000 in 100% stocks. However, for that risk of losing $42,000, roughly 42%, I was rewarded by having $350,000. Here I have $100,000 and my risk was $18,000. All right. So for that risk of losing $18,000, not $42,000, but $18,000, my portfolio grew to $274,000. So that's what it comes down to. Is it worth it? Is it worth it? Now, this doesn't talk about the distributions. Distributions are a different can of worms here. This just talks about risk of holding a portfolio and seeing in terms of what the upside is going to be and the downside. Distributions are different because when you're pulling money out of a portfolio that is declining, say 42% in value, that's you can't do that. That's bad news. Hope that makes sense. So anyway, here's what I tell people: if you're accumulating assets, you're not touching for a number of years, you might as well just go full throttle. I mean, you have enough to cover your bills, an emergency account, GMA, whatever, CDs, to cover your bills, a couple mortgage payments, whatnot. But hell, just go full throttle. Why not get potentially the $100,000 to go to $350,000 over 15 years, as opposed to $100,000 to go only to $274,000 over 15 years? And you think if it goes on this rate of return for another 15 years, that's serious money, man. That's crazy, the difference between those two. It doesn't look so much on an individual year, but over time, that's serious money. All right, so let's see here. Performance in down markets. Let's see. Looking at performance during previous market downturns is another way to gut check your risk tolerance. February 19th through March 23rd, a portfolio with 80% equity weighting would have lost about 27%, compared to a 20.7% loss for a 60% equity stake. And again, see, if your $100,000 is down $27,000, are you really going to be happy if your $100,000 is only down $20,700? No, no. So you might as well just take the losses again, as long as you're in accumulation mode, and just roll with it. And here you can see 60-40 mix in 2008 was down 20%, was down 33%. 60-40 mix in Q4 2018 was down, what's that, 7.5, 12. I don't know. I hope that makes sense. If you're in accumulation and you're trying to reduce the risk to your portfolio, I don't think that's, especially in this low return for bonds. And don't forget, let me just go back real quick. This also shows what the bond market was doing the last 15 years, which is actually a pretty good run, because if we look at this right here, the last 15 years from here, the bonds were trading at 4.5 to 5 and has gone down steadily since. From basically 2007, that's probably October 2007, to now, the yields have gone down big time, which means the prices have gone up, which has given this bond a return even more than you're getting now. So let's go back to the headline. Why your portfolio might need more stocks. I completely agree. Hope this helps. If you have questions, put them in the notes. Love to hear them. I'll put a link in the show notes. Thanks, Chuck, for sending this to me. Good article.